All right, we're just going to do a review through the slide decks we covered and the exam. If I remember correctly, there's only one question on the test that isn't from the latter set of slide deck. So, and that question is the same question that was on the first exam. So, uh, I trust that you'll do okay on that one question on the exam. Uh, we started after the midterm. We came back in and started talking about some of the tax-free fringe benefits. Housing allowance, it's free from income tax, but it is subject to self-employment tax if you do not elect out of Social Security, Medicare taxation. Gifts, we talked about that, you will recall, based on the intent of the donor. Group term life insurance premiums, any church or any other employer can provide group term life insurance up to $50,000 for all employees, and it not be taxable income to the employees. If they provide more than $50,000, then the amount above the premium cost above the $50,000 is income. Scholarships that you can provide. A church can provide scholarships to employees and it not be income to them. Employer paid health insurance premiums are not income. Tuition reductions would not be income if the church ran a school. Lodging for the employer's benefit would not be income. You can provide any employee up to $5,250 a year of educational assistance and it not be income to them. If the employer provides child care on a non-discriminatory basis, that can be non-taxable income. And then the de minimis fringe benefits piece that we talked about. Those things are things like occasional use of a copier or printer or something. So if you had done something at home and you wanted to bring it into the office and copy it on the church's copier or print it on the church's printer, occasional use of that stuff is not taxable income. Holiday gifts of non-cash property with low value, fair market values, a turkey, a box of fruit, etc. Anything they provide, coffee, soft drinks, etc., furnished to the employees, bottled water, whatever. Local phone calls, subscriptions to professional publications, meals or lodging for the benefit of the employer. Now that would be taxable income for self-employment tax purposes. We talked about the $5,250 of employer provided educational assistance and the employer provided dependent care. The premiums for health insurance we talked about. The tax-free status depends on the church having a written plan to provide that health insurance coverage. And if you pay it directly and are reimbursed, then as long as they require that you prove that you had paid it, it's tax-free. The written plan must incorporate recorded commitment in the minutes to do it, a commitment, certain rules and regulations governing payment, communication of the rules to the employees as a definite policy, called an accident or a health plan and operated on a consistent basis. One other item that we talked about, if you get paid on a 1099 instead of a W-2, any medical or health insurance premiums the church pays on your behalf are additional income to you and are included in the amount shown, should be included in the amount shown on the 1099. But you can deduct those on the front of the Form 1040 as one of the not miscellaneous itemized, but one of the adjustments to income on the front of 1040. We talked about church plans. A church plan is a plan maintained for its employees by a church. Health insurance provided via church plan is not taxable as a fringe benefit. Church plan is exempt from discrimination rules. We talked about the small employer thing, and most churches, I believe, would qualify there because they have less than 25 full-time equivalent employees. We talked about Section 125 plans where they can include health and accident or accident and health benefit things: health savings accounts, adoption assistance, dependent care assistance, the group term life thing again, up to $50,000. All those can be paid under a Section 125 plan and not be taxable to you. We talked some about the Affordable Care Act, individual mandate effective March 31st of 2014, and people without coverage are subject to fines and penalties. We talked about all these issues about that. Nothing really major there. 4 categories of employers under the Affordable Care Act: less than 2 full-time employees, more than 1 but less than 50, more than 49 but less than 100, and more than 99. And those categories, the top 2 are large employers, and those are required to provide coverage for their employees. The lower 2 are small employers and are not required at the current time to provide coverage for their employees. Like I said, I don't know of any churches that have more than 49 full-time equivalent employees, so I don't know any churches who would be subject to that, although you may have some denominational boards that have a lot of employees that would be subject to it. We talked about a credit on payroll taxes for offering qualifying health insurance coverage. That credit would be available by filing a Form 990, and you would have to file it just to receive the credit if you had other people, that you're paying payroll taxes on. So that might be an option for some people. And that was the January the 25th slide deck. So on February 1st, we talked about, whoops, is that the February 1st slide deck? I'm sorry, that was the February 1st slide deck. The January 25th slide deck was business expense. Okay. If you receive a W-2, you're considered an employee. If expenses are reimbursed under an accountable plan, they're not income to you, but are not deductible by you. If they're not reimbursed to you, they're deductible on Form 2106, which then flows to Schedule A, subject to the 2% limitation. And we mentioned that the recent tax law that takes effect January 1st of this year, 2018, eliminates all those Schedule A miscellaneous deductions. So for future years, 2018, and in the future through at least 2025, unless Congress changes the law, you wouldn't be able to take any unreimbursed employee business expense. If you receive a 1099, you're self-employed and expenses are deductible on Schedule C. That's not changed under the new tax law, other than the potential 20% exclusion for income for the net income from income tax for the net income that you're not taxed on under the self-employment rules. And I haven't seen anything about the new law and a discussion of whether or not ministers filing a Schedule C would be subject to it. So I just don't know yet. I would argue they are, but the IRS may argue differently. Business use of the personal vehicle. Commuting is not deductible or reimbursable. You can have a choice in the first year of which you use a vehicle to either use actual expenses or standard mileage rate. You cannot flip back and forth between those two. Whatever choice you make in the first year, you have to stick with. So that's just the choice you have to make in the first year in which you use a personal vehicle for business. Parking fees and tolls are deductible or reimbursable. Commuting, we talked about. Any mileage incurred between your home and your primary work location is commuting, not deductible or reimbursable. If you qualify to deduct a home office, you can possibly qualify to deduct for mileage from your home, which is where your home office would be in the church building. But we talked about the likelihood of that not happening because the home office has to be, one of the requirements is for the benefit of the employer. And as a general rule, most churches are going to provide you a place where where you can work. So as a general rule, it's not going to be for the benefit of the employer if you do that. Once you've arrived at your primary work location, any mileage incurred doing business is either deductible or reimbursable. And then we talked about the situation about stopping at a location. So you leave the house and go to the hospital before you go to the church building. Then getting at the hospital is where you start working that day, and from the hospital to the church building and whatever is deductible mileage, no longer commuting. And if you depart from the office, church building, and go home, but you stop somewhere else to do work on the way, that would be not commuting mileage until you've left that last location headed home. We talked about combining business and personal on a single trip and allocating expenses between those two. And if you remember, I told you about my trip to Hawaii where we flew out on a Thursday. Where we flew out on a Thursday, did some sightseeing stuff on Friday, flew to a different island on Saturday, and then I was on Sunday rather, and then I was in class Monday through Friday, and then we flew back on Saturday. And weekends don't count, travel days don't count, so we had one personal day and 5 business days. So 5/6 of everything was deductible, etc., except for, of course, my wife's travel, because that was separate. I couldn't, it cost me more for that. But the hotel room didn't cost any different for 2 people in it, etc. Spouse and children of company, you can only deduct the expense incurred for those who were involved in it. But if no additional cost was incurred, you can deduct the full amount. For example, if you travel all in one vehicle, the mileage for the family is no different than the mileage for you going. So the full thing would be deductible. Meals and entertainment costs must either be directly related to the active conduct of your business or associated with the active conduct of your business. We talked about directly related. The main purpose is to transact business. You do engage in business during the period. You have more than a general expectation of deriving income or some other specific benefit at some indefinite future time. And then you have to demonstrate that the activity was associated with and had this was associated meals and entertainment. You either conducted business before or after you had the entertainment or the meal. That's what they call the clear business purpose test. We talked about books and subscriptions. Those can be tax-free fringe benefit if the church buys them for you. If you buy them yourself, you can either expense them immediately or capitalize them and depreciate them over 5 years, or you could claim Section 179 deduction. So we talked about some of those issues. Education expense, which is required by your employer or by law or regulation to keep your salary, your status, or your job, or that maintains or improves skills required in your present work, are deductible, unless it is the minimum level of education required to meet the job you're in, or part of a program of study that qualifies you for a new trade or business. There have been court cases where people were taking a program that qualified them for a new trade or business, but because they were able to convince the court that they didn't intend to, and it really wasn't, that was just a fringe of what they were trying to do, enhance their and improve their skills in their current business, the courts, when those cases, allowed them to deduct it. But as a general rule, only if it's required to maintain the skills needed in your present job are they deductible. Office supplies and equipment, including computers, can be deductible or reimbursable if they're purchased for use in your job. An example was a mileage logbook, or required by your employer to fulfill your job duties. You have to keep receipts for anything over $75. You have to document the business purpose regardless of the amount. So the only thing you have to keep is the receipts over 75 and the documentation of the business purpose. We talked about office in the home has to be used regularly, exclusively for business at the convenience of the employer and used as the principal place of business. So if the church provides you an office, you can't usually show employer convenience. And if you fully excluded all your housing costs under housing allowance, you don't have any expenses to deduct for office in the home. Specialized clothing, clothing which is of a type general, specifically required as a condition of employment, not adaptable to general or continued usage to the extent that it could take the place of ordinary clothing, not worn as ordinary clothing. Specialized clothing is deductible. The cost of cleaning and maintaining the clothing is also deductible. And we said that buying a suit to wear in the pulpit on Sunday or to go visiting in through the week is not specialized clothing, because it's clothing you can wear any day, every day, as general business or general ordinary clothing. You can never deduct the cost of the first telephone line into your home, although you can cover that cost under housing allowance. Any additional telephone expenses based on proving the business purpose of the expense, allocating costs incurred between business and personal usage, unless the cost included in your housing allowance deduction. Cell phone provided by the employer is not income to the employee if there are substantial business reasons for the employer doing it, i.e., I want to be able to get in touch with you whenever I want to. That's a substantial business reason. We talked about the Deason rule. Deason was a minister who was audited by the IRS in 1964, turned into a court case, and the issue was he was deducting all his business expenses. He had income which included a housing allowance. The IRS stance was that the housing allowance, which was income tax exempt, they should calculate a proration, a proportion of the non-taxable income to his total income, and he should not be allowed to deduct that portion of his business expenses. The IRS won that case, so every tax software package I've seen recently over the last 8 to 10 years definitely have included the Deason rule calculations in it. If you're a minister and you have unreimbursed employee business expense, we go through the calculation of the Deason rule. How much of your income is tax-free, income tax-free, and we do that calculation. How much of your business expenses are you not allowed to deduct because of the Deason rule? Does not apply to calculating self-employment income, since housing allowance is added back for that purpose. Does not apply to expenses reimbursed under an accountable plan, because then they're not unreimbursed employee business expenses. Does not apply to other types of tax-exempt income, like municipal bonds or something like that, that you might be receiving tax-exempt income. It's only ministers' income with the tax-exempt housing allowance that it applies to. And that was what we talked about on the 25th of January. So on the 8th of February, we did the comparative scenarios of 4 different income tax returns. Our standard setup was the minister had his income reported on a W-2, did not have an accountable plan in scenario number 1, was subject to Social Security and Medicare, had not filed a Form 4361 exemption, had a salary of $70,000, a housing allowance of $22,500, net reportable salary of $47,500, his income from weddings, funerals, etc. of $700, health insurance paid by the church of $9,600, and we had a whole sheet worth of other things like the various business expenses he incurred and dry cleaning on his suits and various and sundry other things. So his W-2 looked like this, box 1, box 14, and the state information down in the bottom. On he's just he and his wife. Their children are out and gone. So there's just the two of them. His $47,500 of income, plus $100 because he didn't spend all the money that he was allocating in his housing allowance. So that extra $100 came up and onto the income line of $47,600. His weddings and funerals income on line 12, reported on Schedule C. This is the Schedule C where he had weddings and funerals of $700. We didn't take any expenses against that. That would have been on line 2 here if we had taken some. So our scenario didn't include any expenses there. This is where we got into the Deason rule calculations. We add back his housing allowance here. We add back, and then we calculate his total tax-exempt income, non-taxable income to total, and we come up with a 31.68% of his expenses then will not be deductible. So we apply that 31.68 against the expense. 8,000 miles at the 54.5 cents a mile or 54 cents a mile was the 16 tax return. At 17, it was 53.5. For 18, it's 54.5. Meals and entertainment, parking fees, tolls and transportation, and other business expenses, office supplies, and various and sundry other things included in the 1770. So out of his total $7,272 worth of business expense, he only gets to deduct $4,968 because the 31.68% is not deductible because of the Deason rule. So here we showed the 2106, which has his business expense included on it. And we see the clergy attachment showing how we calculated the 4968. That goes on Schedule A under miscellaneous itemized deductions and is subject to only that portion above 2% of adjusted gross income being allowed on Schedule A. So the rest of Schedule A showed some medical costs, which he didn't exceed 7.5% or 10% in this case of adjusted gross income. So he didn't get to deduct any of that. Some income tax he paid in, some real estate taxes, his home mortgage interest, all that sort of stuff, his charitable contributions, his non-cash charitable contributions. So his total itemized deductions of $25,782. Then we calculate the self-employment tax. We take his $47,500 salary, the $700 from weddings, funerals, etc. We add back the housing allowance to get a $70,700 amount. We take off 100% of his non-reimbursed employee business expense. So his self-employment income is $63,428. That goes on the self-employment tax calculation. So he has $8,962 of self-employment tax, and half of that is deductible on the front of 1040, which serves to reduce his income, taxable income. So it gives him somewhat of a tax break there. We see there where the half of the income self-employment tax gets deducted there. So we calculated for this particular scenario $993 of income tax, $8,962 of self-employment tax, totaling $9,955. The guy we'd had paid in $9,000 of estimated tax, so he still owes them $955. Summary here, the federal income tax was $993, self-employment tax $89.62, Georgia income tax $379. So just over $1,400, or just over just under $1,400 worth of total income tax. And we talked about the Deason rule and part of his business expenses not being deductible. For sample 2, we had the same situation, except he had taken a pot of $7,500 worth that he anticipated incurring in business expenses, so he dropped his salary. Now, that's not an appropriate designation. And I just realized I haven't been sharing these latest screens with you, so let me get back to sharing. All right, I'm going to have to do that a different way. Now we're on the, I'm sharing the right screen now. We were in scenario 2, example 2, sample 2, whatever I called it here. In this case, the guy had talked with his eldership, his men's committee or whatever, and they had set up a reimbursable and accountable plan so he could get reimbursed for his business expense. So they set his salary at $7,500. I'm sorry, at $62,500 instead of the $70,000 we had talked about in the first example. And we're reimbursing him $7,500 worth, up to $7,500 worth of business expense. He only incurred the $73.92 that we talked about. In this scenario, we had less federal income tax, $653. We had less Georgia income tax by $177 less for $202. We had a reduction in his self-employment tax to $32 less. And the Deason rule does not apply here because he didn't have any unreimbursed employee business expense. Everything got reimbursed. So only if he had exceeded the $7,500 in expenses and didn't get reimbursed for something would the Deason rule apply. So that's where we talked about you're better off if you can get an accountable plan, get your expenses reimbursed, especially for 2018 and going forward, since that bottom section of Schedule A, miscellaneous itemized deductions, go away. You don't have the opportunity to deduct those things for 18 through 25. In sample 3, we talked about the same guy as number 1, except he had been approved for exemption from Social Security and Medicare. We said that if he's going to do that, he needs to make sure he pays into a retirement plan, since he won't have access to Social Security for his ministerial earnings. In this case, we had more federal income tax paid because he didn't get the deduction for half of his self-employment tax on the front of 1040. And we had more Georgia income tax paid. Once again, the same reason, didn't get that deduction for the self-employment tax. So his income tax went up to almost $2,100 here, but his self-employment tax went away, which was the $8,962 we had talked about. He was subject to the Deason rule because he did not have an accountable plan. So we saw that very same 31.68% of his business expenses not being deductible due to the Deason rule. In the last example, we had the gentleman being paid on a 1099. And being paid on the 1099, that means that his health insurance premiums were taxable income to him. So in that scenario, he had federal income tax of $413, Georgia income tax $105. His self-employment tax went up as well, over $9,000 here, $92.91. But only 27.9% of his business expenses were not deductible due to the Deason rule. That non-deductible percentage went down because his income went up due to adding back the health insurance premiums. So this was our comparative of the 4 returns. So the income tax is least in item number 2, where he has the accountable plan. It's next, well, I take that back. income tax was less in sample 4, where you got paid on the 1099. And then the sample 2 was next, and sample 1 was next in line, and then sample 3, trying to remember what the difference was. He was exempt from Social Security Medicare, so the income tax went up because of the Social Security Medicare, half of his self-employment tax that didn't get deducted. Okay, that was what we had on our, let me stop share, and the 215 scenario. Okay, on the 215 class, we talked about audit considerations. They audit very few tax returns, generally less than 2%, really less than 1% in most cases. And the vast majority, over 70% of those, are what we call correspondence audits. They just send you a letter about the computer decided that this and this didn't match, so tell us about it. We think this should happen, or we recommend, or if you don't answer it, they'll probably assess tax based on that. So we talked about the individual statistics. 1.742% of people with individual returns with less than $200,000 of AGI, non-farm business income, between $25,000 and $100,000. And we said that's probably where you'd wind up as a preacher, somewhere in that range. So the odds of being audited are very slim. If your AGI, non-farm business income, goes up, it somewhat increases your percentage or risk of being audited, but it's still barely above 2%. We gave some average itemized deductions amount for taxes and interest and charitable contributions, miscellaneous itemized deductions. We gave some breakouts of some of those, like income taxes and real estate taxes, mortgage interest versus other interest, cash and check contributions, and unreimbursed employee business expense, just to give you an idea of what the universe is like out there. We talked about, once again, self-employed versus employee. Remember that the IRS considers a minister as an employee for income tax reporting purposes, but self-employed for Social Security. Being paid on a 1099 could be a red flag for an audit. We talked about housing allowance and failure to document the agreement of the housing allowance, or failure to substantiate the 3 different limitations in claiming housing allowance could be a red flag. We talked about the accountable plan and claiming expenses under an accountable plan without having a written authorized accountable plan could be a red flag. If you're audited owe more tax, you generally have 3 options: pay the amount without an argument, or request a payment arrangement. You generally, in amounts less than $35,000, can do that online with no big hassle on it, or make an offer in compromise. And in order to do that, you need at least 6 months worth of income and expense information, and have to complete an IRS financial statement in order to get them to even talk to you about it. Very involved, very long process, although you hear radio commercials all the time about people who are willing to take your money and do that on your behalf, but it's still a very long and involved process, and most of the fees I hear them quote are very excessive for the amount of time they're going to spend on that, doing that. We talked about the responsible party for failure to pay employment tax issues. We talked about 100% penalty for failure to properly pay payroll taxes. Any responsible party is anyone with knowledge and the ability to pay who fails to fulfill the obligation to pay. We talked about issuing 1099s for non-employees. I used examples like custodial service or traffic control or visiting ministers, etc. This is if you hire somebody to come in and hold a meeting and you pay them $1,000 plus expenses, you should send them a 1099. You should give them a W-9. They should fill it out. That gives you all the information you need to have to provide them with a 1099. Failure to issue 1099s can subject the church to penalties. It used to be $50 per failure to do so. So if the IRS, I've not known them to ever audit for something like that, but that's possible. If they don't give you a W-9, you should withhold 28% of what you were going to pay them. So if you said, I need this W-9 filled out, and the minister said, I'm not going to do it, then instead of paying them $1,000, you pay them $720 and send the other $280 to the IRS. Now, when you send it into the IRS, you're supposed to say who you withheld it from. And if he won't give you his social security number, it's going to be hard to tell the IRS who you withheld it from. It's going to be hard for him to get credit from it at the IRS. So just a little amusing thing to me. We talked about the letters that the IRS requires be sent out by churches for contributions in excess of $250. The failure of the church to include the proper statement regarding whether or not goods or services were received in exchange for those contributions can enable the IRS to disallow that charitable contribution, or failure to have the letter in hand prior to filing the return can result in disallowed deductions. We talked about the excess benefit intermediate sanctions, and that was what we talked about on the 15th of February. On the 22nd of February, and I've got to stop share again. This is getting to be a hassle. Glad I've only got 3 more slide decks to go. We talked about current issues, the minister's housing allowance and the lawsuits by the Freedom from Religion Foundation. They've also in the past filed lawsuits about filing form 1023 and filing form 990. I talked about the Blue Ridge Mountain Barbecue up in Blue Ridge, where they came in and fussed at him about offering people a 10% discount on their meal on Sunday if they brought in their menu or their church bulletin. We talked about the Religious Liberty Charitable Deductions Act of '97. We talked about state and local taxes, property taxes, legally organized or trusteeships, open carry laws. We talked about you cannot engage in substantial efforts to influence legislation. We talked about you cannot participate in, intervene in, or any political campaign on behalf of any candidate for public office. You as a minister have certain free speech rights as an individual, but when you put on that, walk into that pulpit, you are speaking on behalf of the church, and that's where they draw the line. We talked about the Trump executive order that really doesn't change anything. We talked about Representative Jones from North Carolina trying to repeal the Johnson Amendment, which is the amendment that put that restriction in place. And then we talked about a requirement to update responsible parties on Form 8822B if you change your address or who's responsible for whatever it may be. So 2 more slide decks to go. I'm sorry, I skipped February 22nd. So let's jump back and get it. That was where we talked about retirement plans. There's 2 options, a church plan or an ERISA plan. A church plan is a plan Established and maintained by a church or convention or association of churches for its employer or the beneficiaries of its employer. Also includes entities tax exempt under Section 501, controlled by a church or convention or association of churches. So the Presbyterian Publishing House, for example, they could have a church plan for their employees. Church plans or plans established under state law and are exempt from ERISA as a provision of ERISA. The law itself says they're exempt from being covered by ERISA unless they elect under Section 410D to be covered by ERISA, in which case it's subject to all ERISA provisions. We talked about what those ERISA provisions are: reporting requirements, disclosure requirements, fiduciary responsibilities, non-discrimination rules, having to pay for coverage under the Pension Benefit Guaranty Corporation, minimum participation requirements, minimum coverage requirements, and minimum vesting requirements. A lot of cases and private letter rulings that allow a retired minister have a portion of their retirement income designated as housing allowance. But we talked about that's an old court case, and that from 1989 forward that the IRS refused to issue any rulings or determination letters on that particular issue. The court case or the revenue ruling that originally authorized it was issued in 1975. So that's over 30 years now that they've just chosen not to do anything about that particular matter. We talked about the Clergy Housing Allowance Clarification Act, implementing the restriction that non-taxable amount of a housing allowance cannot exceed the fair rental value of the house, including furnishings and utilities. We talked about the ERISA plans. Those plans originally, we talked about church plans. These are ERISA plans. You hear about 401k plans or 403b plans. These can be either defined contribution plans. The plan defines how much will be contributed on your behalf, or defined benefit plans. The plan defines how big a benefit you will get upon retirement. Defined benefit plans can be used to give much greater deductions because you can calculate for a very small group of people how much they will get as a benefit, and that can bump up how much you need to fund the plan in order to get or to financially secure that level of benefit in the future. We talked about self-employed people that can do IRAs, SEPs, or solo 401ks. IRAs, you can put in a maximum of $5,500 till you turn age 50, in which case it goes to $6,500. Contributions may or may not be tax deductible depending on other income. When you do withdraw the money from the IRA, it's taxable as ordinary income. If you withdraw it before age 59 and a half, you have a 10% penalty for early withdrawal, unless you meet any of a variety. I think there's about a dozen or so exceptions, potential exceptions to that. A SEP is an simplified employee pension plan, and you can put in up to 25% of net earnings from self-employment, up to $54,000. Once again, withdrawals from the SEP would be taxable as ordinary income. A 401k plan, you can defer from your salary $18,000. If you're under age 50, over age 50, you can defer up to $24,000 plus up to 25% of net earnings from self-employment, totaling no more than $54,000. So depending on what your income is, you might be able to put aside more in a solo 401k than you could under a SEP. Withdrawals from the solo 401k are taxable as ordinary income, just like the other two. And that's what we covered on the retirement plan, other than the statement that I strongly urge anybody and everybody to make sure that if you're going to elect out of self-employment tax, that you do have some sort of retirement plan that you're funding yourself, because you will not get Social Security or Medicare for your ministerial earnings. Last week, the last session we talked about was financial controls, where we talked about segregation of duties, transparency, and oversight being the three main cornerstones of financial controls. Segregation of duties means that more than one person is involved in doing things, documenting, recording, reconciling, reporting. Transparency means that financial information is disseminated such that any interested party can, with minimal effort, confirm accuracy and completeness of the information. And oversight, the ability of independent parties to review and confirm that accuracy and completeness of financial information. Whoops, I went the wrong way. We talked about various areas where we might need some of those things, like in counting, recording, depositing, and the contributions, dispersing funds and reconciling the bank statements, preparing payroll and filing payroll tax reports, those sorts of things. We talked about budgeting, where transparency means, and every year as we prepare budgets, I give a report to all of our deacons about here's what was spent in every area last year, and that report goes out to every one of the deacons. There are a couple of areas we pull out of that, benevolence being a big one, simply because of the confidential nature of what we do in benevolence, except that we do, for our deacon who is in charge of benevolence, give him that report. So it's one of those things where when you're budgeting, when you're doing financial reporting, when you're doing member letters for contributions, all those issues, you want as many people to be aware of and involved in as possible. And like I said, we send out member letters for every contribution being made. Part of that is if a member says, well, where's this check? Or I wrote check number blah, blah, blah for this amount, and it's not there. That could be a red flag to an issue somewhere that, you know, somebody's not doing something properly. And then we talked about the potential for fraud, theft, and issues where you need some oversight to, and sometimes it's just simple oversight that can easily catch something and prevent fraud and theft from happening. We talked about state unemployment issues, where each state's law is different, ministerial withholding and Social Security gross-ups, properly documented plans and annual amounts. And I think that is it as far as everything we talked about since the midterm. And if I can close that and end share. Okay. I'm going to stop the recording, and then I'm going to email you the midterm. And when you finish it, I'll leave the leave this up so we can interact after you've finished it. And if you want to, I forget how you did it last time. I think you did it in Word or something, but it's up to you. I'll send it to, do you want me to send you the Word document as opposed to a PDF?
That would be easier, yes, sir.
Okay. I'll email you the Word document, and when you get it finished, send it back to me, and we'll go through grading, okay?
Yes, sir.
Any questions before I do that?
No, sir.
All right, Justin.